Hey everyone, Longacres Finance here, and today I will be talking about dividend yields. And more specifically, I'll tell you the best dividend yield to aim for. And that dividend yield is 3.52%. Now if you're wondering how I came up with this number, well, a dividend investor like a journalist does not reveal his sources. Alright, obviously that is a joke. But I bet for a few of you watching out there, that actually sounds like a decent dividend yield to aim for. And for the rest of you, let me break down this topic, and perhaps help you figure out the answer to this question. Maybe you're a seasoned dividend investor, or just starting out your dividend investing journey. Deciding what dividend yield you should aim for is a challenging question. While there is no straightforward rule investors can use to answer this question, there are a few simpler questions that can point you in the right direction. To keep things at a high level, I'm going to say that there are two forms of dividend investing. The first is a focus on cash flow, and the second is a focus on growth. Let's break these down further. The purpose of dividend investing is to create a passive cash flow stream. And during the contribution phase of your investing journey, this cash flow stream is reinvested back into the portfolio, creating the compounding growth effect. So it would make sense for the current cash flow to be as high as possible, right? If you can get $100 per month versus $50 per month in cash flow today, your portfolio would obviously grow quicker with the $100 cash flow stream being reinvested. Nice and simple. On the other hand, with the growth approach, dividend investors focus on stocks that are growing their dividend payments at a higher rate. Growing your dividend income at 15 to 20% per year over 10 to 20 years will give you a very nice passive cash flow stream that will also benefit from compounding during that time frame. Companies that already pay a large dividend yield typically have a high payout ratio, which is the proportion of earnings per share eaten up by the dividend payment, and therefore they have less room to increase their future dividend payments. Companies that pay a small dividend yield typically have a low payout ratio and can sustain higher dividend growth for many more years. So it appears that if you focus on either high yield or high growth, you sacrifice the other factor. And your goal as a dividend investor is to find a balance between these two factors. So you need to ask yourself, do I go after higher cash flow or do I go after higher dividend growth? And which option fits my investing goal better? This will be unique to your individual situation, but let's walk through a few scenarios. To do this, let's look at it from a few perspectives. The first being your current age and investing timeline. If you are young and you have a long investing timeline of 20 to 30 years, you have the time to invest in more dividend growth stocks and take the risk that they will continue to offer faster growth in the future. If you're older and expect to use the passive dividend income in the near future, you should probably focus more on high dividend yield stocks right now. It can take a long time for high dividend growth to outpace a high dividend yield approach, and it isn't guaranteed either. Older investors may not want to take this risk. Another perspective that will gauge your investing approach is your tolerance for risk. This may be difficult to gauge, especially if you're new to investing. The stock market, over long periods of time, goes up, but in the short term, it can swing up and down. And depending on the beta of your individual holdings, your portfolio may swing a lot or very little in respect to the entire stock market. Beta is just a reference for how much a stock moves in either direction in relation to the broad market. Higher yielding stocks are typically mature companies with a lower beta, and they tend to not swing as much during volatile market periods. This means you won't see massive daily paper losses in your brokerage account, but you also won't see massive daily gains. Dividend growth stocks, on the other hand, may see higher gains and larger losses on a daily basis, and they typically have higher betas. If you're comfortable seeing your portfolio value swing up and down, your risk tolerance is high. But if you think you'll lose sleep at night seeing those high swings, then your risk tolerance is low. So if your risk appetite is higher, take more risk with faster growing dividend stocks. And if you're more risk averse, focus on higher yielding stocks and sleep well at night. While there is no right or wrong approach to creating a dividend portfolio, you should pick an approach you are comfortable with. Because you work hard for your money, and you deserve to have it invested in a manner you're comfortable with. Ideally, we would invest in high yielding dividend stocks that also offer a high dividend growth rate. But these stocks are hard to come by. If your main goal is to create a high passive dividend income stream quickly, then it will be pretty difficult to beat high yield with high growth. Consider this example. If you have $1 million and you invested in a portfolio with a dividend yield of 5% and a dividend growth rate of 3%, you will receive $50,000 in passive income in year number 1. In year 2, you would receive $51,500 in passive dividend income and $53,045 in year number 3, assuming your portfolio continues to grow at 3% per year. This income stream is purely growing through dividend increases and assumes no dividend reinvestment. Now if you instead opted to invest in a portfolio with a dividend yield of 3% and a growth rate of 8%, you would receive $30,000 in passive income in year 1, $32,400 of passive income in year 2, and $34,992 in year number 3. It would take 11 years for the 3% dividend yield portfolio to catch up to the 5% dividend yield portfolio in terms of passive cash flow, and that's without dividend reinvestment. With dividend reinvestment, it would take an additional 7 years for the 3% portfolio to catch the 5% yield portfolio. On the other hand, after 20 years, assuming no dividend reinvestment, the 3% dividend yield portfolio would pay over 50% more than the 5% dividend yield portfolio. And more specifically, that would be the difference between receiving $140,000 and $90,000 in passive dividend income. But 20 years is a long time to wait, and many things can change between now and then. You can't just assume that the dividend growth rate will continue at a fixed rate indefinitely. Personally, I tend to favor dividend growth more than high yield, but I have a long timeline before I plan to retire, and my goal is to increase my portfolio yield as I near retirement. But honestly, investing in dividend stocks based purely on dividend yield or dividend growth is not the best approach. You should instead focus on finding quality growing businesses with wide economic moats, and then make sure the dividend yield and dividend growth match your requirements. If you're younger or have a bigger appetite for risk, then targeting a 1 to 2% portfolio dividend yield with a high double-digit dividend growth rate may be right for you. But if you're older or have a low appetite for risk, or just want to focus on the cash flow part of dividend investing, then targeting a 3 to 5% portfolio dividend yield with an average dividend growth rate that is higher than inflation may be right for you. You can of course shoot for a higher than 5% dividend yield, but by doing so, you increase the chances of picking up stocks that are more at risk of a dividend freeze or a dividend cut. Also, many of the highest yielding stocks offer little to no capital appreciation, which should be taken into consideration as well. Let me show you how to play around with designing a portfolio using the stocks on my 2 monthly watch lists, the high yield dividend stock watch list and the quality dividend stock watch list. Between the 2 watches for April, there are 54 stocks to choose from. But let's say I want to build a portfolio of 20 stocks, and I want the current dividend yield to be above 2% and the 5-year trailing dividend growth rate to be above 10%. I'm going to be picking stocks at random here, so this is not a recommendation of any kind. You should certainly do more research on a stock beyond the data shown here. So here are all the 54 stocks, and I will start with an equal allocation to each of the 20 stocks I pick. That means 5% per stock. This column shows the allocation to the respective stock. This column shows the dividend yield as part of the entire portfolio, and this column shows the historical dividend growth rate as part of the entire portfolio. So let's make some random picks here and see how it shakes out. I will choose Charles Schwab, United Healthcare, MSCI, Home Depot, Tractor Supply, Texas Instruments, Visa, Roper Technologies, Sherwin-Williams, Microsoft, Amgen, Cisco, Evergy, Kimberly-Clark, Lockheed Martin, 3M, Pepsi, Principal Financial Group, Royal Bank of Canada, and Toronto-Dominion Bank. All 20 stocks make up 100%, offer a combined dividend yield of 2.21%, and have a 5-year dividend growth rate of 14.37%. So this meets my goal of a 2% minimum dividend yield and a 10% historical growth rate. And notice that none of the 20 stocks make up a significant portion of the current dividend yield or the dividend growth. Therefore, if any of these stocks stop paying or growing their dividend, it doesn't drastically affect my portfolio as a whole. The odds that you'll stumble on a bad stock or two during your investing journey are quite high, so it's usually a good idea to spread your risk around. Now, if I wanted to get a higher current dividend yield, I could tweak the allocation by lowering the lower yielding stocks to 4% and increasing the higher yielding stocks to 6%. This bumps up my current dividend yield by 0.21% to 2.42%, but lowers my growth rate by almost 1% to 13.39%. Another option is to add 5 additional stocks to my portfolio and keep my allocation equally split at 4% now. By adding higher yielding stocks like DTE Energy, Kellogg, Alliant Energy, Philip Morris, and WEC Energy, this would raise the portfolio yield to 2.49%, but further lower the dividend growth rate to 12.62%. Look, this barely scratches the surface of the debate on what the ideal dividend yield is, but I hope you found something that I mentioned useful. If you did, please like the video and subscribe to the channel for more insightful information about the wonderful world of dividend investing. If you have any questions, you can post them in the comments below, or shoot me an email at longacresfinance@gmail.com. That's it, thank you for watching, and see you next time.